Imagine you find the perfect house, but you aren't quite ready to buy it today. Instead, you pay the owner a small, non-refundable fee. In exchange, they give you a contract that locks in the purchase price for 30 days. This is exactly how a call option works. This contract has three key parts. First, the premium. That's the fee you paid up front. Second, the strike price, the specific price you've locked in for the house. And third, the expiration, the date your right to buy the house officially ends. If a new park is built nearby and house prices in the neighborhood skyrocket, your contract becomes incredibly valuable. You still have the right to buy that house at the original, lower price, even if the market price is now twice that amount. But if the neighborhood goes downhill and the house value drops, you don't have to do anything. You aren't forced to buy a house that's losing value. You simply let the contract expire. Your only loss is that initial fee you paid to the owner. This makes a call option a powerful tool. It lets you participate in the potential profits of a big price jump while knowing exactly how much you could lose if the price goes the other way. Now, let's say you already own the house. To protect your investment, you might buy an insurance policy that guarantees you can sell the house for a certain amount, even if the market crashes. In stocks, this insurance is called a put option. As this graph shows, the put acts as a floor. By paying an upfront premium, you've secured a guaranteed exit price. No matter how far the market value falls, you have a contract requiring someone else to buy your asset at that locked-in price. Actually using this contract to sell your asset is called exercising. For most people, this is a massive headache because it requires having the actual house, or the full cash value of 100 shares of stock, ready to move at a moment's notice. This is why most traders don't bother with the physical asset. Instead, they just sell the contract itself. If your insurance policy becomes more valuable because the market is crashing, you can sell that piece of paper to another investor for a profit and walk away with the cash. Options trading is largely about these paper contracts. You're trading the rights and the risks associated with an asset, which allows you to profit from price moves without needing the huge amount of capital required to own the actual stock. While buying options is a great way to limit risk, those upfront fees, the premiums, can get expensive, especially if you're making several trades a month. To lower that cost, traders use a strategy called a bull call spread. You buy the option you want, but at the same time, you sell a different option to someone else at a higher price. The money you collect from the option you sold helps pay for the one you bought. This significantly reduces your out-of-pocket cost, but look at the top of the graph. Because you sold an option to someone else, you've agreed to a ceiling. If the stock price goes to the moon, your profit stops at that line. A spread is a practical trade-off. You're choosing a cheaper entry price in exchange for giving up the chance at an unlimited, once-in-a-lifetime windfall. Buying a put to protect your stocks is a smart move, but paying for that insurance month after month can start to feel like a drain on your savings. A strategy called the collar attempts to solve this. You pay for your downside insurance, but fund that cost by selling someone else the right to buy your stock if it hits a much higher price. The money coming in from the sale helps offset the money going out for the insurance. This creates a defined box for your investment. The stock can still move up or down, but it's now restricted. You've established a clear floor to stop your losses and a clear ceiling that limits your gains, often for a very low net cost. Advanced trading is about clear boundaries. You trade away extreme, unlikely gains to ensure a sudden market crash can't do serious damage to your portfolio. So far, we've been the ones buying the contracts, but what if you wanted to be the one collecting the fees? When you sell an option, you're acting like the insurance company, taking cash up front from others. This can be a steady way to make money, but it's dangerous if you're naked. That's when you sell an insurance policy promising to buy someone's stock, but you don't actually have the cash in your account to follow through when they finally call you on it. This is the absolute danger of a naked put. That tiny block at the top is the premium you collected, but if the stock price drops towards zero, that red bar represents your obligation. You could be forced to buy a worthless stock for thousands of dollars, a loss that is much larger than the small fee you collected. This is why the safest way to do this is a cash-secured put. This vault represents the cash you keep in your account. You only sell the option if you already have the money set aside to fulfill your promise, ensuring you can never be wiped out by a single bad move. Selling options can be a reliable source of income, but it means stepping into the part of the financial world where you are responsible for the risks of others. Let's look at a real example. Imagine you sell a put option on a volatile stock. You collect $750 in premium right away. Even though cash is in your account, your profit is zero. This balance sheet shows why. That cash is perfectly offset by an open liability, the promise you made to the market. To cancel that promise right now, you'd have to pay back exactly what you were given. If the stock price starts to fall, your promise becomes more expensive. The cost to cancel your obligation is now higher than the money you collected. On your screen, you'll see this as a growing loss. To get out, you have to buy to close. This just means you buy back the exact same contract you sold. This cancels out your promise and permanently closes the trade. To stay safe, sellers use a stop loss. If the cost to buy back hits this red line, your broker automatically closes the trade for you. It turns a potentially massive disaster into a small, controlled loss. Income strategies like this depend entirely on how you handle these open liabilities. It's the daily discipline of watching the exit door that keeps a bad trade from turning into a total disaster.